Investing $500,000 every year for 20 years into the S&P 500 could easily get you $370,000, which is a return of 270% on your investment. This is a lot better than letting your money sit in a savings account collecting dust, and is precisely the kind of thing an intelligent investor like Warren Buffett would do. But how do you know if you're an intelligent investor? And if you're not, how do you become one? Welcome everybody. My name is Ryan, and I'm the 1% Club, and I'm here to help you with your investment journey. Today we're going to look at how you can become an intelligent investor like Warren Buffett and achieve financial freedom as soon as possible. Before you can start investing like an intelligent investor, you first have to lay a strong financial foundation. There are multiple ways you can go about building this strong foundation for investing, so I'll go over the ones I think are most useful and I practice on a daily basis. First off, you need to expand your financial education. This subject isn't normally taught in schools, so it's up to you to become financially literate. You can start doing this in a number of ways, such as reading financial books, listening to podcasts, watching YouTube videos or movies, talking to successful people who have achieved what you want to do, and so much more. To get started, I'll recommend some great books and YouTubers. The books I think are definitely worth reading are The Intelligent Investor by Benjamin Graham, Rich Dad Poor Dad by Robert Kiyosaki, and One Up on Wall Street by Peter Lynch. The YouTubers I recommend are Andre Geek, Max Mahler, Charlie Chang, Graham Stephan, and of course myself. Sorry to anyone if I butchered your name there, I'm not the best at pronouncing. By watching this video, you've already made a start on building your financial foundation, so good on you. The next way you can build your strong financial foundation is by developing directionally correct habits. Directionally correct habits are habits that improve who you are either physically, mentally, spiritually, or in other ways, and they should help you head in the right direction when trying to achieve your goals. Some examples of directionally correct habits are reading for 20 minutes a day, or working out twice a week, or even just going for a stroll in the park each day to get some fresh air and clear your mind. Anything that improves who you are and helps you achieve your goals is a directionally correct habit, no matter how small the action is. So constantly improving your financial education is a great directionally correct habit when trying to become an intelligent investor. Here is a quote from one of my favourite financial books called Richer, Wiser, Happier. Resounding victories tend to be the result of small, instrumental advances and improvements sustained over long stretches of time. Basically, what this means is don't underestimate the power of directionally correct habits, because the small actions are what make the big victories. My third tip for building a strong financial foundation is to learn to live below your means. An example of living below your means is, let's say you make $750 a week, and your weekly expenses are $250, and then you spend $150 going out eating and partying and so on. You'd be left with $350 a week to save or invest. This would mean you'd be living below your means. One of my all-time favourite quotes is, "The man who makes $20 and spends $19 is happy. The man who makes $20 and spends $20 is miserable." Sadly, I can't remember who said that quote. Another way you can live below your means is to pay yourself first. This is the act of paying yourself a percentage of your paycheck for saving or investing before paying your expenses or going out to party and so on. Living below your means is a very strong directionally correct habit for trying to achieve financial freedom, and I highly recommend you start doing it if you haven't already. So now that you have started to develop your financial education, you're living below your means, and have started other directionally correct habits, your financial foundation will soon be strong enough to start investing. Let's now look at getting started in the world of investing and really start becoming an intelligent investor. It gets pretty difficult to decide which businesses to invest in when there are thousands of companies across dozens of countries. However, you can cut down the number simply by understanding yourself and the type of investor you want to be. The first thing you need to understand about yourself is, what is your risk profile? Maybe you hate risk and only want to buy blue chip stocks. Or maybe risk is your middle name and buying growth tech bio stocks is your game. You need to figure that out for yourself. The easiest way to find out your risk profile is to ask yourself, how badly do I need this money, and when am I going to need it? Once you understand your personal risk profile, you should only look at investments and companies that suit your risk tolerance. Understanding your risk tolerance is a great start to picking stocks and will probably eliminate the mass majority, but you still have more to get rid of. An intelligent investor like Warren Buffett invests in the companies and industries they understand, as this gives them an edge over the investors who know nothing about what the company does or how the industry works. So if you're a scientist, you may want to stay away from oil stocks, and if you work on an oil rig, you may want to stay away from pharmaceutical and tech stocks. Basically, what I'm saying is, you should invest in what you know. You could have a very big head start on other investors by investing in the industries and companies you know the ins and outs of. Warren Buffett is a clear example of investing in what you know. He chose to not invest in stocks like Google and Walmart simply because he didn't understand how those businesses could survive. Understanding your risk profile, as well as investing in what you know, will probably leave you with a list of certain investments and stocks that you could potentially invest in. But this isn't enough. To be a truly intelligent investor, you need to view these stocks as owning a portion of the physical business as opposed to viewing it as something like a gamble. You need to review the fundamentals of the business. Some important fundamentals are things like the PE ratio, the PEG ratio, the PB ratio, past and future earnings growth, the EPS, the dividend yield, and a lot more. If that confused you, leave a comment down below if you want me to make a video about the important business fundamentals and what they mean. Once you have reviewed these important fundamentals, you will be able to make an informed decision about which companies on your list are in a strong financial position and are worth investing in. Using your competitive edge by investing in what you know, combined with understanding how the business fundamentals work, is kind of like playing roulette and betting on red, except 70% of the pockets are red and the rest are black. Basically, what I'm saying is, chances are the odds are in your favour. The next part about being an intelligent investor sounds pretty easy, but it's actually where a lot of investors and especially speculators go wrong. You need to buy great companies for good prices, or good companies for great prices. That sounds quite simple, but identifying what a good or great company is can get pretty difficult, let alone figuring out what a great or good price is to pay for the stock. The best way to follow this advice is to understand the fundamentals of the business to identify whether it is a great, good, or terrible company, and then calculate the company's intrinsic value to uncover if you are paying a fair price for the stock or if it is overpriced. Remember, the more undervalued the stock is, the greater your margin of safety, meaning your investment is potentially safer, but this is a no guarantee. Once you have followed the previous steps, you will most likely be ready to invest. But when investing, there are two main ways you can buy an investment, either by a lump sum payment or by dollar cost averaging. A lump sum payment is when you invest all your money at one time, while dollar cost averaging is the practice of investing portions of your money over a set period of time, maybe weekly, fortnightly, monthly, it's up to you, until you have invested all the money you want to. Each method has advantages and disadvantages. However, when investing for the long term like an intelligent investor, most people tend to favour dollar cost averaging. This is because dollar cost averaging is often seen as less risky and also makes you more likely to buy at the dip when stocks are going down. Also, Warren Buffett prefers dollar cost averaging over lump sum payments. So you've built a strong financial foundation, have gone through the process of getting started, you've probably chosen a few stocks or investments you believe are right for you, and have invested in them. Now comes the truly hard part, which is maintaining your investing practices over a sustained period of time. This could be a year, couple months, couple decades, that's honestly up to you. One of the best things you can do to maintain the growth of your investments is to never dip into your savings. Selling some investments because they started to make some money and you want to use it to buy a new car or a phone completely interrupts the snowball effect called compounding, which Warren Buffett calls the eighth wonder of the world. If you want to be a really intelligent investor and achieve financial freedom, you will deny instant gratification in favour of delayed gratification. The best way you can avoid selling your investments in the short term is by ignoring the daily fluctuations that occur in the stock market and other markets. An intelligent investor like Warren Buffett does not get caught up in the constant short-term noise such as quarterly reports, short-term inflation or interest rates, and so much more. Instead, they focus on the long-term view and review how a company or investment will fare in the long run. The best thing you can do is make an investment and then forget it exists for a couple of years. You wouldn't check the price of your home every day, so why would you do the same with a stock? Just because I'm saying the long run is more important than the short term, don't forget the importance of the short term. We have covered how an intelligent investor like Warren Buffett would go about building a strong financial foundation, how they would get started investing, and how they would maintain their growing wealth over a long period of time. But I would just like to remind you that life isn't only about investing in money. So remember, above all, just enjoy your life, because it's the only one you're gonna get. Thank you all so much for watching. If you enjoyed this video, leave a like and subscribe. This was my first time making a longer video, so if you prefer this type of format and length, make sure to let me know down in the comments section. Thank you for making it to the end. I hope you have an incredible day, and I wish you luck in your investing adventures. Bye bye!